Next, we're going to shift gears a little bit to the economy. To introduce our next speaker, I'd like to invite Bill Shad, Regional Vice President of TD Bank, up to the stage. TD is a gold sponsor for today's event and always an incredible supporter of MEREDA. We are immensely grateful for this partnership. Bill, would you like to come on up?
Thank you, Craig. We are also very grateful for the partnership between TD and MEREDA. The annual forecast conference is an annual highlight for many of us. It's really an opportunity to bring the best and brightest in real estate, development, research, and other professionals into one room to talk about the issues and opportunities that face the state of Maine. One of those topics is clearly the economy. So we have a very strong labor market. We have inflation seemingly under control. However, there will be some headwinds in the current year that may or may not make the outlook optimistic. So it's good to hear from experts. Today we have James Marple, senior TD economist, who has joined us for a number of years in the past, who will share his in-depth look at the economic projections for 2024. So James, welcome. Here he is.
All right. I feel like Bill could have done my presentation. He preempted me on all my points about inflation and the economic outlook. So thank you for having me again. It's great to be back. I called this landing the plane because I think, as noted, a lot of the risks that we spoke about a year ago in terms of the economy potentially having a hard landing, going into recession, really worries around the rate at which monetary policy, or which the Fed funds rate had risen, and interest rates more generally had increased, that would lead to some deleterious effects for the economy. Since then, we've seen really nothing but economic resilience, both in terms of overall economic growth and the job market. That, at the same time, inflation has really slowed, and I'll talk a little bit more in depth about that. So that should allow the Federal Reserve to start lowering interest rates this year. And they have a bit of dry powder available because, of course, the Fed funds rate has a range of 5.25 to 5.5%. So, up from zero just a few years ago. So that, I think, is an important element of the outlook, obviously, that I'll get a little bit more into. Okay, so it is interesting that obviously economists across the board have been expecting growth to slow and have been right about that everywhere but in the United States. We have seen everywhere else that growth really has slowed quite dramatically over the course of the last year as interest rates had risen. The U.S. has been the one exception to that, where growth really in the second half of 2023 really outperformed expectations. The growth rate in the third quarter was above 5%, and we just had an update on fourth quarter growth was above 3%, 3.2%, with solid consumer spending, pretty much strength in all the places you'd like to see it. So, in fact, this forecast for the U.S., we had 1.5% growth on an annual average basis. We will have to be revising that up when we put our forecast update out in March. I was going to say we are in March, but no, we're not. There's one extra day of February. And that really, again, is unique to the U.S. We expect to see continued. We do think we'll see a slowdown in the rate of economic growth and some upward movement in the unemployment rate. But there again, better story than we had anticipated even 3 months ago. And of course, as mentioned, a key part of that is that we have had cooperation on the inflation front. There was inflation data printed today. The personal expenditures price deflator. I don't know if you saw it in the news today, but it continued to slow, 2.6% on the headline rate. The core rate, which is kind of good to look at because it's what the Federal Reserve looks at, has also fell, but it was at from 2.9 to 2.8% on a 12-month or year-on-year average. Now here, I think it is important to mention, if you've been following the business news, you will have seen that in the last few months, we have seen some upward tick in the month-on-month change in inflation, and that is something that we've seen a lot of volatility in financial markets around expectations for Fed policy as a result of that. But we're not quite there in terms of where the Fed certainly would like inflation to be, around the 2% mark. That core rate still 2.8%, and again, that's the 12-month measure. But we are seeing that the month-on-month metrics are actually running in advance of that. So I think it's a good news story, but the risks, there still are some risks and uncertainty around that. And again, so having this resilient economic growth at the same time that inflation's come down, I mean, that's the best case scenario. And it has happened because we've seen the supply side, where we really had seen after COVID and shutdowns in global production around the world, economy shutting down, that drove up the supply costs, and you could see that in just the cost. One metric of that is the cost of shipping around the world. Now, more recently, obviously, it's come down and has been pretty low over the course of 2023, or at least in line with historical norms. But that has started to move higher, and I'm sure you're aware of the geopolitical risks that is one, I'd say, source of outside risk to this otherwise pretty good news story. But one way that is playing out is in an uptick in the price of shipping, and of course that will flow through to goods prices, and again slow some of the progress perhaps that we have seen. So something to watch for. Obviously nowhere near where we were, and fingers crossed if there isn't a major conflagration or exacerbation of some of the existing geopolitical risks, this will continue to cooperate. But certainly having the supply side, and that's true actually even more broadly than just shipping costs. We have seen that there has been pretty strong productivity growth, which is the kind of thing that allows you to get, again, good growth and even disinflationary economic growth. Of course, the other side of that, the strong economy, is the labor market is still running very hot, and it's been mentioned a few times. And I do have some slides on Maine, but I always want to say that what I'm saying about the country as a whole also very much applies to Maine. This is U.S. data, where we have data on the number of job openings relative to the number of people who are looking for work or available to work, and that ratio is still above 1. So there are more job vacancies than there are people to fill them. We have seen that come down, and there has been some improvement in terms of participation in the labor market, but you still have a rate that is well above what it has been historically, and that has showed up in an accelerating rate of wage growth. Wage growth is running, by various metrics in the 4 to 5% mark. That is perhaps a little bit high with what you would think is consistent with stable inflation, again around the 2% mark. Of course, you can have higher wages growth if you have higher productivity, and there is some evidence that is part of the story as well. But I mean, I think two things here. One, it's nice to see it moving in the right direction, but still at levels that are not normal. And again, to see that in the rate of job growth, which is outpacing underlying growth in the labor force given population. We've had that if you look at sort of how the U.S. population grows, that's consistent with about 80,000 jobs. And if every month, we'll get another job report next week, but every month, that data has been reported, we've seen over 200,000 and even an accelerating rate of growth in January. And this is the 3-month average, but the month-on-month was over 300,000 for both January and December. So, 3 times roughly what you'd think is consistent with growth in the underlying population. So no signs really that of slowing here, and I think that's obviously really positive. So that's shown up in an unemployment rate that is at a pretty close to an historic low. I only have the data going back here to 2019, but you can trust me, this is basically a 50-year low for the unemployment rate at 3.5%. For Maine, the unemployment rate has moved up over the last several months, but at its trough there earlier in 2023 at around 2.5%, that was the lowest it had ever been. So lower really than is sustainable, and we do expect to see some modest upward movement here. But again, it's hard to see upward movement in the unemployment rate as long as job growth is running so much faster than growth in the labor force. So we have been expecting it, but that's an area where we have not seen it come through in the data. But why do we think growth will slow? Well, here are a few reasons. One, we have seen that the impact of higher interest rates is starting to feed through to consumers. You see this in some movement up in delinquency rates. We've also seen, obviously, rates of utilization of credit cards really increase. And you've seen that a lot of the excess saving that occurred during the pandemic, both as a result of generous fiscal policy, but also due to people not being able to spend, that resulted in an increase in liquid saving. Really, you see it in a big uptick in checking deposits. That has started to turn the other way, or rather, if you kind of compare the level of deposits or savings to what it was prior to the pandemic, it looks like for almost all income groups that has been exhausted. So, some of the resilience I think we've seen is that there has been this store of available spending, and now it looks like it's largely been unwound. And you see that in terms of some of these trends here, showing on the right just the fact that higher interest rates have really do have an impact on what is an important purchase in the economy, the purchase of a new vehicle, and that has showed up in a slowing rate of vehicle sales and vehicle production. Now, of course, higher interest rates have also very much hit the housing market. The mortgage rate, hovered around 7%, and that has really been resulted in a deterioration in housing affordability, especially coming after the large run-up in prices over the course of the pandemic, but I think as was referenced by Elizabeth and the previous speaker, there's really a supply issue as much as a demand issue, and that's true even on a national basis, where if you look at the level of home sales, a turnover of housing, existing home sales, they have fallen basically to where we were in 2008. But the number of homes available for sale on the market is so much lower. Inventories are so tight that houses are not staying on the market very long, even at relatively depressed sales levels. So in that environment, it's kind of hard to see much in terms of price adjustment, because there's still a mismatch between supply and demand. And you can see that there has been some, there was a leg down in prices in both the new and existing market, but it has rebounded for existing sales, where that supply is more important. We have seen new sales, prices for new sales continue to fall on a national basis. Looking at trends in Maine, the growth in home prices in major metros in Maine has been faster than what we have seen in the country as a whole. That has been decelerating everywhere, well, almost everywhere. But again, that means that the deterioration in affordability in the state is worse than we see even on a national basis. And reading the real estate reports for the state, that story about limited supply, tight markets in terms of the month's supply, and I realize I'm talking to a room of real estate developers, so that's as much as I'm going to say about that. Okay, commercial real estate, obviously, again, facing the challenges that are very much related to the COVID pandemic, and mentioned the work from home, which has led vacancy rates, even in a hot economic environment of record low unemployment. We've seen movement up in vacancy rates of office space, a little bit more on the multifamily as well. But that office space, I think, is where we continue to see that these are really structural headwinds. And in some ways, it's surprising that we have not seen more stress in those markets. I think there are still a lot of companies that are having leases where they have, maybe 60% of their workforce in the office, but they're still continuing with the same, to have the same leases. And over time, I think there's going to be a readjustment there, a rethinking of that. So I think there is still room for the vacancy rate in office space to move higher. And that will show up. I think that this will continue to be a news story where you've seen it even in terms of thinking about what are the downside risks or what could go wrong. Worries in the financial sector about losses to commercial real estate, I think, isn't something that's going to go away immediately. That said, lower interest rates will help a lot. And on that front, this is the year in which pretty much universally rates have been expected to go down, whether you ask financial market participants, whether you ask economists, or you ask the Federal Reserve themselves in their published economic forecasts. All of them expect to see a lower policy rate by the end of this year than what we have today. Now, the amount at which rates decline, I think, obviously is a bit of a source of debate, and that will depend on the continued cooperation of inflation and also probably seeing some slowdown in some of those labor market metrics that I had talked about previously. If that doesn't happen, I think the Fed will be reluctant to make their first cut. You've seen consistent communication from members of the Federal Open Market Committee that they need to be convinced that inflation is on a path toward their 2% target. Not that it has to reach it, but if you're starting to see things like wiggles higher in that data, that's the kind of thing that would stall the start of what we think will be rate cuts. And the reason we have rate cuts going, kind of indefinitely, it's interesting because typically the Fed's cutting rates because the economy's slowing. We have a little bit of that, but it's mainly because inflation is getting close to target. So as long as that story continues, I mean, the federal funds rate at 5.5 is well above where even the Federal Reserve thinks it should be in the long run. So they publish quarterly their expectations, and members of the Fed, the policy-setting members, think the Fed funds rate should be 2.5. So that's 300 basis points higher than where they think it should land. And that would say that if everything's kind of moving as expected, that rates should be a bit lower than they are today. Okay, so just on that, just mention, because I don't have a slide here on the mortgage rate, but what we expect to see is that as the short-term rates come down, that will filter through to longer-term rates, but especially in the mortgage market where there is quite a big spread on what the typical spread between sort of risk-free rates and mortgage rates. And if that compresses a little bit alongside falling bond yields, then we should see the rate move down. And we're near 7% now for a 30-year fixed-rate mortgage. We think it should be closer to 6% by the end of this year, and around 5% over the long term, as I say, consistent with what we think the policy rate should be at. Okay, so obviously it's an election year. We have to recognize that there are some risks on the fiscal side, depending on the outcome of elections. I think it's just important to note that there's a continually, even with a very hot economy, a deficit of 6% of GDP in an environment in which borrowing costs have risen. The cost of servicing the federal debt is likely to eat up 3% of GDP on an annual basis, and will only continue to move higher as long as deficits are where they are. Obviously choices to be made in terms of cutting the deficit, but there's a big debate around taxes. If you cut taxes, then you're going to have a bigger deficit unless you cut spending at the same time. Not rocket science, but you can see here kind of what that debate around some of the tax cuts that have been put into place. Some of them expire, and that typically people don't like when tax cuts expire and try to make them permanent, but that will, the CBO's baseline, the Congressional Budget Office, which estimates the size of deficits, bases it on current law. So, that's, in fact, it's a bit of a trick, right? That laws are written so that they don't show an increase in the deficit because they expire at some point in the future. But then when you get to that point, the trend has been to extend them, and there you have a new budget issue to deal with. Okay, so now I'm going to close on a few slides more on the local economy after all that good news on the deficit. But what we've seen, I think, this is an important thing to watch, and I think well recognized that the issue isn't demand or really the economy is growing as much as it can. It's really the constraints on growth coming on the supply side. And in the aftermath of COVID, many of those were exacerbated, especially in New England. And you can see that here if you look at the size of the labor force relative to what it was when the pandemic hit or the first lockdowns happened, we're still, the chart, you got to be careful of charts like this, but it's still 2% smaller than it was prior to the pandemic. Now it's 2% larger for the country as a whole. I think it's not an exact mystery why this is the case. An aging population, people have left the labor force, and many more people left the labor force through the pandemic that haven't come back in. But I think what's interesting is there has been some good news on that front, that the population growth in the state, according to the census estimates, and I unfortunately don't have 2023, but the year just ended with 2022 data, but there has been a real uptick, it was mentioned, in terms of movement to the state. And that is absolutely, all population growth in Maine is going to be people moving in to the state, because more people every year die than are born in the state. And in fact, that challenge will not go away, that in terms of the births minus deaths is negative, and will be for a long time, because you don't change the age structure of the population, even with very strong migration flows, enough to change that arithmetic. But if you can attract enough people in, you can see what has been strong population growth. I mean, 1% population growth is the strongest we had seen since the mid 1980s, and that's keeping pace with the country as a whole, despite being the oldest state in the union. Just to show that demographic challenge, I mean, you can see it here, the age structure of the population. I'm sure you guys are aware of this, but Maine is the oldest state. The biggest sort of segment of the population in terms of share is 60 to 64. They're moving, that labor force challenge. People tend to retire. You see a big drop off in labor force participation, as you know, around 65. So keeps moving further and further away, and it's a little bit better in the cities, obviously, but like in Portland, but still relative to the country, show a much older and a kind of, you think about the deer and the python, it keeps moving into that aging cohort. So that is challenge I think everyone is aware of, but as long as we can bring people in and build enough housing for them and deal with some of the affordability challenges, then this is a dealable problem. But it does mean more expenditures on healthcare and the economy structured toward an older population. Okay, I got a minute and a half of time left, so I don't know if we had if there was questions I had questions in the past. So if there are any questions, I'd be happy to take them.
What concerns you most?
Wow, list of worries. I mean, I think some of the exogenous shocks, kind of, you have unknown unknowns and known unknowns. I think in terms of some of the known known unknowns. It's some of the geopolitical risks. I mean, obviously, there's, again, in an election, there's issues in the South China Sea around Taiwan that don't look like they're really going away. Obviously, what's happened in the Middle East, I think, those are the kind of things that could push the thing off course, that they're there, but you just hope that nothing worsens. I think in terms of some of the domestic risks, again, I think the commercial real estate hasn't fully worked its way through in terms of some of the office vacancies in central business districts. That's a challenge. That, again, I mean, there's a lot of leases and mortgages that are coming up for renewal that will be renewed at much higher interest rates. If interest rates come down, that helps, but that, I think, is still something that's important. I guess, if I had to leave it at those would be my top two. Yes, maybe I think I'm at 0, so this is the last. I have one question. Yeah, absolutely. That's my third. Yeah, I mean, I think that, the reality is that borrowing costs for U.S. debt have remained low. Being the global reserve currency has allowed, despite high levels of debt, to continue to fund at pretty low levels. But, that assumption has been challenged a little bit by what we've seen over the last couple of years. And I think that, even with rates low, I mean, high debt levels start to crowd out investment, and it's kind of a own goal. But certainly, I think that's there as something that is at least a source of risk. It also lowers any flexibility. I mean, if there is another, God forbid, pandemic or recession, I mean, you can't blow out the deficit again the way we have in the past. I mean, increasingly, your hands are tied in terms of your ability to deal with crises should they arise. But I mean, absolutely. I mean, I think what will have to happen is more deficit reduction than is in the CBO baseline. Okay, that's it. Thank you very much.
Well, James, thank you very much. As always, that was really insightful. I was an econ major. I love all this wonky stuff, but it's particularly great when the forecast is positive like that. So thank you. As we move on, I also just want to take a note and just say how many people are here. These chairs are full. There's standing room only in the back. We've had 3 great speakers so far. Can we just have a round of applause for all the folks who spoke this morning?